Good morning. Today we're going to finish Chapter 2. As those of you coming in, I do have a handout down front here. You don't absolutely need it right now. If you're online, it should pop up as you sign into the room. If not, let Brian know. We'll get to that in just a minute. I just wanted to hand it out early so I wouldn't have to. We're not going to do it right this second. So today we are going to finish up Chapter 2. And we're going to, and I would say if I had to pick one chapter in the entire book that was more important than any other chapter, it would be this one. This is fundamental to everything else we do in this class. We don't have cumulative tests in here, but that said, chapters 1, 2, and 3 impact the rest of the course, especially chapter 2. And 3 is real key too. And there's a lot of rules we have in this class. So let's go to the next slide. You can just type the URL. Okay, so maybe you have to do file load. Okay, Brian's going to take care of you guys online and get it for you. Okay. Okay, so what I've done with this blue handout, and I don't mean to make this the focus of class or anything, this is more a reference for your purposes, and we're not going to directly go over this handout until we go to do a couple problems. And I'm going to put this on Blackboard as well. It's called the Debit Credit handout. And what I've done, you just take a quick look at it. The debit credit language is kind of foreign at first, and that's normal. Very few people look at debits and credits and go, oh yeah, instant, that makes sense. And I don't know when it made sense to me, but it certainly wasn't the first couple months. So this is one of those things where you really have to, I want to say memorize, but you don't need to memorize, you need to use the rules. So in this handout, this is deciding whether something's a debit or credit and how to do the entry. So this handout, what I've done is I've put down the steps that you actually go through. So when we go to do this later today, when we're figuring out an entry, whether we debit something or credit something, we'll use these steps. And again, this handout will be on Blackboard on the home page, and Brian is pushing it out. He put the URL out there. You can click on it to get it as well. And if you just walked in, it's down here if you want it, but you don't absolutely need it. But I used this last semester for the first time, and it's basically when you have a transaction and you have to figure out what to do with it, these are some good questions to go through. So we'll refer to that. I just wanted to hand it out early, so when I can't hand out during class very easily. So that's there for your reference. Okay, so we talked yesterday, or Monday, about TAccount briefly, and I'm not going to lecture on them now, but just to review. A TAccount is just a way of keeping a running total of a balance in an account. It's not a formal mechanism. So companies don't have TAccounts per se, but it's a way to figure things out. So with the TAccount, the left side is always debit and the right side is always credit. Debits and credits don't necessarily increase or decrease. The first thing we have to get out of our minds when we think about debits and credits, the thing that most people are most familiar with is your bank statement. And your bank statement, they say, when they increase your account, they say, we credited your account. And we'll talk about why that doesn't apply to assets. And they're backwards from you. So we'll talk about that later on today. But so don't rely on what the bank statement says as a reminder, because it's backwards from assets. Okay. So that was the debit credit handout URL. If you're watching it later, the handout is on Blackboard, but it's also right here at this URL. Okay, now, debit credit rules. Again, some of these things you're just going to have to take at face value. They make sense later on. Everything in accounting is built around this idea that assets equal liabilities plus equity. Every transaction has two sides, and our debits have to equal our credits. Now, certain debits will increase some accounts and credits increase other accounts. skipping ahead. On your exam, every exam you have in this class, you will be able to use one 8.5 by 11 piece of paper. So a piece of paper like this. You can write on it, you can type on it, you can use both sides of it, but it can be only one physical sheet of paper. Okay, so this is your exam reference sheet, not this one, but anything that you would want to use. One sheet of paper. We'll talk more about the exam next week. That's not what I'm trying to get into here. But what I'm trying to say is there are certain things in this class I would put on that sheet, and this is one of them. Okay, actually this handout today, a lot of that might want to go on your sheet. But these rules here about what increases and decreases accounts, these are things that if you didn't have that sheet, I would be telling you, memorize these. Okay, these rules about what debits increase what kind of accounts. Debits increase assets, liability, or assets, expenses, and dividends. Okay? So to increase an asset, if cash goes up, we're going to debit it. To increase an expense, we're going to debit it. To increase dividends, we're going to debit them. Credits, on the other hand, increase liabilities, common stock, retained earnings, and revenues. And if you see a common theme there between debits increasing and credits increasing, that's kind of like assets equal liabilities plus equity. Assets increase with debits, liabilities and equity increase with credits, and then we think about it further. Expenses and dividends belong over with the debit increase for assets. And then the opposite is true. So if you know debits increase assets, expenses, and dividends, then debits have to decrease the other ones. So this right here, I would absolutely, positively have on every reference sheet I have for an exam in this class, okay? Because we're going to be doing a lot of transactions in this class today. We have a ton of questions to go through. And some of that I'm going to be saying to you, okay, so we know what account's affected. We know that cash is impacted. So we want to increase cash. What do? Debit or credit it? Well, we just look down on our sheet and we know we debit it. Okay, so now on to why your bank statement's backwards. Because when you get a bank statement, the bank statement will say that we credited your account for $100. Maybe you made a deposit and they credit it, and that increases your balance. And then they'll say for the bank charges, like if they charge you for checks, they'll say we debited your account and that decreases it. Okay, the reason that that's backwards from everything we do is, let me ask you this, the bank. So think about the bank itself. Your checking account, what type of account is it to the bank? Asset, liability, or equity? The checking account. So you take $500 to the bank and open up a checking account. That checking account to the bank, is that an asset, a liability, or an equity? Liability. It is a liability because the bank owes you $500, right? You give them your $500, they now owe you. So your checking account at the bank is a liability, okay? So when you make a deposit and they say on their statement, we're crediting your account, why are they doing that? Because liabilities increase with a credit. So if you want to memorize anything or use the bank account as an example, what you've got on your bank statement are the rules for liabilities. Okay, because that bank statement, that bank account that you have at the bank is a liability to the bank. So they are crediting it to increase it, they are debiting it to decrease it. But when we talk about cash for a normal company, the company's own account, cash is an asset, so to increase it we debit it and decrease it we credit it. And I find that's one of the single hardest things to figure out about this is that banks are backwards, but you have to remember your checking account at the bank is the bank's liability because they owe you the money. Okay. Okay, so this should be an easy one because you have those rules that we just went over. So, which of the following statements about the rules of debits and credits is correct? So I'll give you a minute to read that. What do you think? statements about the rules of debits and credits is correct. It is an asset is increased by a debit. Okay, an asset is increased by a debit. I just went backwards. Okay, so next up, we're going to talk journal entries. Now, every transaction has an impact on the accounting equation, so it's still in balance. Every transaction has equal debits and credits. And when we record transactions, we record them using something called a journal entry. Now, this is a representation of journal entry on paper form. Okay, so journal entry, back when they did it by hand, very visual. We have the date column, then we have the account, an explanation, and then a debit column and a credit column. There's some things you need to know about journal entries, because even if we do them electronically, there's some things that hold true, and especially on the homework, and the homework reflects real life too. So these aren't just made up rules for the homework. First of all, debits are always listed first. You do all your debits first. In this case, we have one debit and we have one credit. But if you had 3 debits and 1 credit, your debits would all go first. It doesn't particularly matter which debit goes first usually, so you can use, so all your debits go first. So in this case, we're debiting cash. So cash is over in the left-hand side of that account column. And then we put the amount, the $50,000, under the debit column. Typically in journal entries, we do not use dollar signs because we know a journal entry is in dollars. It always has to be in dollars. Then for the credit side, the credits come after the debits. The credits are indented. So where you see common stock on the screen, that is indented, I don't know, 5-10 space or something like that, but they are indented. So that indenting means this is a credit. So even without looking in the credit column, we know this is a credit. It has to be indented. If it's not indented, it's wrong. So credits are indented, and then the credit here goes in the credit column. And then down below that, the third line down, issued common stock. So that's like a memo line or just an explanation of what this journal entry is for. We always write explanations for what they are. So that's the basic format of a journal entry. And of course, the date's out there in the top of it. Yes? Your debits will equal, the question was debit and credit. Yes. Just I'm repeating your question. Okay. I said the debit and credit will always be the same, and the correct way of phrasing it is the debits will always equal the credits for each journal. So this one we have debit equal 50,000, our credits equal 50,000. If we had 2 debits here, one for 20,000, the other one would have to be for 30,000 because it has to equal the credit. So your debits have to equal your credits. Debits have to equal your credits. So anyways, in this entry, incidentally, is cash increasing or decreasing? It's increasing. Okay? It's increasing because it's being debited. So we know that from looking at our list of rules. Is common stock increasing or decreasing? Increasing, right, because it's credit. It's being credited. So what we have here is cash is increasing, common stock is increasing. If we didn't have that memo line there, we would know that this was issuing common stock because we're increasing our common stock and we're increasing cash. So someone's giving us cash for common stock. So that's the basic format for journal entry. We have a debit column, credit column. Every journal entry, the debits has to equal the credits. Okay, so exercise 2.6. Okay, exercise 2.6, we have a list of transactions, and we're going to do the journal entry. And at the bottom part, you don't need to write all that out. I'm just saying that a journal entry, just as a reminder, we're going to do the date, then the account, and then the debits and the credits. So we're going to start with March 15th. We borrowed, for the first transaction, borrowed $31,000 from the bank, signing a note payable. Okay, so we borrowed $31,000 from the bank, signing a note payable. Before I do this journal entry, I'm going to use my handout, okay? So the handout, first step. So we're going to learn a way that we can figure our way through most journal entries, and you're it right now. So, okay, so step 1 says pick one account that is affected by this transaction. So what's one account in that transaction? Cash, okay? So then our next question is this account you picked in step 1 increasing or decreasing? It's increasing, okay. So then what type of account is cash? An asset. So you know how we're on step 3 now? So now we know we have cash, it's an asset. Then, let's see, it's increasing a cash, and then step 4, what do we do to cash to increase it? Debit it, okay? So we know in this journal entry right now that if I could write, but I can't, if I could write right now, so all of you should be writing the first line. This is not a hint to you, Brian. Okay, yeah, you don't have, no, I don't, yeah, that's what, no, it was not a hint. Okay, so for what you should write right now on that first line of the journal entry is cash debit for $31,000. Okay, so you see what we just did? Okay, ignoring, we're not writing on the screen, but you're writing cash debit, not you, Brian. Okay, okay. So now we're back to, now we're going to repeat steps 1 through 4 for the other side of this transaction. Okay, so now step 1, pick the other account. What other account is involved here?
Long-term payable or note payable.
A note payable. We'll just call it a note payable. We don't know if it's short-term or long-term, and it's not relevant right now. So note payable. Okay, so note payable is the other side. Next question, is note payable increasing or decreasing?
Increasing.
It's increasing, okay. So step 3, what type of account is note payable? Liability. Okay, so we have a liability increasing, so we've done steps 1, 2, and 3. And then step 4, what do we need to do to that liability to increase it? Credited. Okay, so we are going to credit note payable. So I've got the journal entry there, and then below it I write what it was, a memo line. Sometimes I'll use those, sometimes I won't. March 15th, my journal entry looks like this. My debit is first. It goes in the debit column, the left column of the last 2. Note payable is credited, so I have to indent note payable, and $31,000 goes in the far right column. And then I just have a memo line afterwards about what it is. March 15th. Now, we'll go on, but we'll go on to March 22nd. Now, March 22nd, I'm going to Okay, I'll start with you, Alyssa. Okay, so we're going to go through the handout for March 22nd again. So we're going to do the same thing, okay? So March 22nd, we perform service for clients. The question is, do you always need to use a memo line? In your homework, yes. Okay, and in real life, yes. In here, I don't know that I take the time to write it down, but your homework will guide you through. But yeah, in real life, absolutely, because you won't remember. The auditors will come in a year from now and say, what was this for? And you'll be like, I have no idea. You know, so yeah. Okay. Alyssa. Starting with our step one, pick one account that's impacted. So March 22nd, it says perform service for clients on account totaling $8,900. So this is a little more challenging, but you know one account that's involved there. Accounts receivable. Excellent. Excellent choice. Okay, so accounts receivable. And the reason you were cued off to that is it says on account. Whenever you see on account, that tells you right then that accounts payable or accounts receivable is involved, okay? And you made the choice accounts receivable because we're performing the service somebody owes us. So accounts receivable. Okay, so next question is accounts receivable increasing or decreasing? Increasing, yes. Step 3, what kind of account is accounts receivable? Asset, okay. So step 4, what do we do to that asset to increase it? Debit. Okay, so we know on this journal entry, the first line is going to be accounts receivable, debit for $8,900. Okay, now, perform service, now we're going to repeat. Okay, so what's the other side? This is a little more. You got the hard one, though. So. What did we do? We performed service, right?
Yeah.
What do we get for performing service? What we earn revenue. Revenue, yes. Okay, and this was, and granted, this was challenging. This is service revenue, okay? So we'll go with service revenue for the answer for step 1, okay? So service revenue. Next question, is service revenue increasing or decreasing? Increasing, okay? Step 3, what type of account is revenue? It's a revenue account, right? Okay, and then step 4, what do we do to a revenue account to increase it?
Credit.
Credit. Okay, so we're our journal entry. Our journal entry is going to look like this. We're going to have accounts receivable, $8,900, and credit service revenue for $8,900. Now, I want to point out something. Alyssa had picked accounts receivable, so she did the debit. She was confident in that. Now, the next line, the credit line, the next line, you knew it had to be a credit. We didn't have to even know what account it was. So we could have gotten a date here. We could have gotten accounts receivable. We could have gotten the $8,900 debit, and then we could have gotten the $8,900 credit. The only thing we'd be missing is the account, so we kind of look down the account and pick it. Worst case, we get 75% of it correct, but you've got a good fighting chance there. Okay? So there's our entry for the 22nd. And I'm moving to you, Blake. You're sitting in the wrong place again. Okay. Now, we're moving on to March 28th. We received $5,600 cash on account from clients. So the first question is, pick one account that's impacted by March 28th. Cash, great. Cash is my favorite account because it's easy. You look at it, it makes sense, everything. So cash, what kind? So our next question is, it increasing or decreasing? Increasing. Next question, what type of account is cash? Asset. And what do you do to increase an asset? Debit. Okay, so our debit line is going to be debit cash for $5,600 cash. Now, we're going to repeat. So we have the first line. So now my question is, what's the other account involved here? We received $5,600 cash on account from clients. Can you narrow it down to 2? Yes, it is accounts receivable, yes. And again, we've got those words on account. So it has to be accounts payable or accounts receivable. And the big clue here is we received it on account, so it's receivable. So what we're going to see here is we're going to see accounts, and if we were to finish, I guess I should have finished that. So our question is, it's accounts receivable. Accounts receivable in this case is decreasing. Our client is paying us, so they don't owe us as much. So we're going to decrease accounts receivable, which is an asset. To decrease it, we credit it. But we already knew we had to credit it because we had the cash done. So we know we had cash debited for $5,600. We're pretty confident. The other side has to be credit. Something for $5,600, and it's accounts receivable. Get one free pass. I'm just going back to you. Okay. Okay, and you have this, right? You feel pretty confident about this. So our next one is March 29th. We received a utility bill of $900, an account payable that will be paid during April. Okay, so on this one, answering the first question, what's one account that's impacted in March 29th? How about utilities expense? Yeah, utility. You were right. You were on the right track. But the terminology here is utilities expense. Okay. So utilities expense. So our next question is utilities expense. Is it increasing or decreasing?
Increasing.
It's increasing. What type of account is utilities expense? Expense. Okay. So what do we do to increase an expense? We're on step 4. Debit. Okay. So we know our debit. Our debit is utilities expense for the $900, right? So we have half our entry done. How much is the credit going to be? 900, right? So the only thing you have left to do now is pick out the account that's being credited. You want to hazard a guess?
Account payable.
Account payable. Yeah, well, it says it. That's a good clue, right? But if it had said on account, we would know that we were paying it. So our entry here, very good. See, it's not bad to work through. Okay. So we're going to debit utilities expense for $900. We're going to credit account payable for $900 for March 29th. You will be fine. So on the 31st, okay, trust me, you will be fine, okay? Okay, so on the 31st, we paid monthly salary of $2,600 to employees. What's one account that would be impacted there? Salary expense. Let's call it salary expense. Yes, you had it right, okay? So we'll call it salary expense. That's our one account that we've picked. Okay, so our next question is salary expense increasing or decreasing? Increasing, right? Because we're incurring more salary. So we're increasing salary expense. And salary expense would be we would debit or credit it to increase it. Looking at our list of rules, it's an expense account, right?
Debit.
Debit, yes, okay? So we're going to, March 31st, we're going to debit salary expense for $2,600, correct? Okay. So what's the amount of our credit then? $2,600 is our credit. So the only thing we have left to do now is figure out what the credit is, what account, right? So can you take a guess as to what is going on there? So we have salary expense. What do we pay it with? Cash, yes, exactly. So we are going to have yes. So see, it wasn't bad, right? Okay. We are going to debit salary expense for $2,600 because we increase an expense with the debit. We're going to credit cash for $2,600. We're crediting cash because we're spending cash. It doesn't say, when it says paid, we make the assumption that that is cash unless we're told otherwise. When it says paid, that's implying that we're handing over cash. Okay, we're going to pause here for Yeah, let's wait, and I'm going to take questions, and we're going to switch over to another file check. Yes. Hold on.
Okay, go ahead. So because cash is decreasing, that's why it's going to be credit?
Yes.
Okay.
Yes, because we're in step 4.
You're handing
Cash.
over money.
Yeah, cash. Yeah, cash is decreasing, and it's a decreasing asset, which is cash. That's why we're credited.
Okay.
Yeah. Okay. Yeah. Wait. So that everyone can hear you. Yes.
Okay, so it doesn't matter if the company paid like with a check or a credit card, it would still just be debited as cash. Credit or debit or credit as cash.
Okay, if the company paid with a credit card, it does matter. But we are not getting into those fine details right now, because if they pay with a credit card, that's actually a liability. Okay, because they owe it. But when if you pay with a credit card, you're going to pay your bill a month from now or whenever you get it, right? So if you pay with a credit card, it's actually credit card payable. You're going to credit card payable or something like that. Yeah. Mm-hmm. Yeah. And whenever, for our purposes, we're not going to complicate it with are they using plastic or cash. When it says paid, it's cash. Okay? Come on, I'll put that hand up. Okay, I guess we're done with our question break. Okay, another question. When a company borrows cash from the bank, okay, A, total assets remain the same. B, liabilities are increased. Retained earnings are decreased. D, total liabilities remain the same. What I would say to you to answer this is scratch out the journal entry in the margin. Look at what you would do. Approach this with that handout about what accounts are impacted, what type of accounts those are, and I'll give you a minute, and then I'll take answers. I'll go polls for answers. What do you think?
B.
B, liabilities are increased. Okay. What was your journal entry? What would you debit here? Cash, right? Okay. And what do you credit? You know it.
Accounts payable.
Yeah, like notes payable, loan payable, accounts payable, something like that. One is a payables account. We know it's a liability. So we have assets increasing and liabilities increasing as well. So the only answer that makes sense, you're absolutely correct, is B. Okay, liabilities are increased. Yes, we didn't have any incorrect answers. Great. Good. Next one. Now, do you have a question? Okay. When a company pays an amount it owes a creditor, A, assets are decreased and net income is decreased. B, assets are decreased and liabilities are increased. C, liabilities are decreased and net income decreased. And finally, D, assets are decreased and liabilities are decreased. A couple things to note here. First of all, I would do the little journal entry off on the side. You don't need amounts. You just need a debit and a credit. And also, as a reminder, what's net income? How do you calculate net income? Do you remember? Bad place to sit, yeah. Yes, it is. It's revenues minus expenses. So when we talk about income, you just have to look at what type of accounts you're looking at, okay? Which may or may not be relevant to this question. So I'll wait about 20 seconds, and then I'll canvass for answers. Okay, so what do you guys think? You trying it what? Okay. Well, let's talk about the journal entry before we do the answer. Okay. On the journal entry, what's one thing that would go on in that journal entry? What's one account? So let's just go through. Accounts payable, yes. Okay, so accounts payable, is it increasing or decreasing? Decreasing, right? Because we're, right? So accounts payable is decreasing. What kind of account is accounts payable? Liability. Okay, so according to our handout, if we decrease a liability, what do we do to it? Credit. No. Debit, yeah. Found it. It's okay. That's not how on our handout, referring to our handout, we can just look at liabilities decrease and get the answer, which is debit. This is where I was going with this. Okay. So we're decreasing liabilities. So then the other side, what do we pay with? Cash. What kind of account is cash? Asset, and we are increasing or decreasing? Decreasing. So we're decreasing assets and we're decreasing liabilities, right? Yeah, D. D is the choice, right? Brian? Okay. Right? So it makes sense. What? Oh, it's hidden at the bottom. Yeah. Okay. So what we have here, assets are decreased because cash decreases. When we say pays or paid, that's cash. And liabilities are decreased because we're paying off accounts payable, so we are decreasing our liabilities. Receiving a payment from a customer on account. A, increases stockholders' equity. B, has no effect on total assets. C, decreases stockholders' equity. D, decreases liabilities. Okay, so on this one, receiving a payment from a customer on account, what's one account that's impacted? What do we receive from a customer? Money, cash, right? Okay, what kind of account is cash? Asset. Okay, would that cash be going up or down? Up, increasing. Okay, so what's the other account now involved? On account has to be either accounts payable or accounts receivable. Which one? You said it.
This would be account receivable.
Account receivable, yeah, and that's an asset, right? So accounts receivable is decreasing. Cash is increasing. Both of those are assets. So the answer would be C. Has no effect on total assets because cash is going up. Good job, by the way, and accounts receivable going down. Yes.
Can you explain that?
Can I explain that again? Okay. In this scenario, cash is, we're getting cash, right? And cash is an asset, so it's going up. Accounts receivable is an asset, right? And they're paying it off, so it's going down. So we have one asset increasing, another asset decreasing. So the overall impact on assets is 0.
Are we supposed to just assume that they're paying it off? Because as in right now, all we're doing is receiving a payment. So
right. It doesn't have to be paying it off. It's just, let's put a number on here. We received $100 from a customer. Okay? So if we received $100 from a customer, cash is going up for $100, and accounts receivable is going down by $100. That's it. Assets are going up by 100 and down by 100 at the same time.
why are accounts receivable going down and not up?
Because accounts receivable is an asset. Do you agree?
Yeah.
Okay. They're paying it off, right? They're not off, but they're paying some. They're paying at least something that they owe us. We're decreasing. The accounts receivable is a total of what customers owe us. And if somebody makes a payment, they don't owe us that $100 anymore. So the account has to go down.
I mean, all it says is you're receiving a payment. It says nothing about they're paying on it. So that's why it's confusing for me.
Okay, it's never going to say they're paying on it. This is what it's going to look like. Okay, you receive a payment, okay, from a customer on account. Whenever you see on account, it has to be an account payable or account receivable, okay, because they're paying on account. That's what that terminology means. It means that you're paying on accounts payable or accounts receivable. In this case, it's receivable because it's a customer. If we were paying our own bill, it would be accounts payable. So on account means they're paying off some part of their account or the whole thing. It doesn't matter if they're paying part of it or all of it, but they're paying down what they owe us. Okay? Next one. Okay. Online, it looks like I'm talking. Can everyone else hear me? That's fine, but I just want to make sure people, the sound meters, everyone online, can other people hear me? Because the sound dial's going. You want to ask? Oh, there, the chat window. Okay, I couldn't see the chat window. Okay. Okay, so exercise 218A. Turn this into on your book, okay? Exercise 218A. Okay, 18A, we have a list of transactions, and we're going to be doing the journal entries for the transactions. And I just put the journal entry form up here. We're not going to use it just as a reference. Our debit column is the one second from the right. The credit column is the far right one. Second break here. Oh. Let me just. Okay, she should pop in. Thank you. Okay, so first one. Let's see, where am I going to start? Let's start with you. Okay. Okay, so looking at our sheet, our first transaction, we received $19,800 in issued common stock, April 1st. So pick one account that's impacted.
Cash.
Cash. Okay, that's my favorite account. Good one. When you look at these things, it's a nice thing to say it's cash involved because cash is the easy side, right? So the next question down is it increasing or decreasing?
Increasing.
Increasing, and what type of account is cash?
Asset.
Asset. So what do we have to do to it to increase it?
Debit.
Debit it. So we've just run through steps 1 through 4. So we know we're going to have a debit to cash for $19,800. Okay, so that's one side. And then we could go down below, indent, and do our credit for $19,800. So the only thing we need to know now is what's the other account. So what's the other account? Common stock, right? Because that's what we did. So we put common stock is our credit for $19,800, and we know that we would credit it just going through our list. We pick common stock for the second set. Is it increasing or decreasing? Increasing. And what kind of account is common stock?
Equity.
Equity. And to increase an equity account, we credit it. Okay? So we're just verifying that what we came up with was correct. If you get cash right on one side, the other side is going to be correct because it has to be a credit. Your debits have to equal your credits. In this particular one, we're going to have one example where the debits do not or we have more than one credit or more than one debit. Okay, so that entry is going to look like this. We're going to see cash debited for $19,800, crediting our common stock for $19,800. Okay, now let's see. Hello. You're next. Okay. April 2nd, we purchased $200 of office supplies on account. So going through, I'll grab some of those. Okay, now, so first question, step one. Pick one account that's impacted April 2nd. We purchased $200 of office supplies on account. Pick something that would be impacted there. No, just pick, looking at this, ignoring accounting terminology, just say, what's impacted in April 2nd? What are we buying? Office supplies, excellent answer. Okay, so that's step one, okay? What is that office supplies increasing or decreasing? It's increasing. And what type of account is office supplies? Asset, okay? And then step four. So we want to increase an asset. What do we do to office supplies? We want to increase an asset. Debit, okay? So we are going to debit office supplies for $200, right? Now, so now let's repeat because we finished this. So let's go back up. Now we know we're going to have a credit for $200, correct? Because our debits have to equal our credit. So can you narrow it down to two things that would be impacted? Or two accounts to pick from? Or do you know the other side of this? The other account? Account payable. Excellent. Yes, because I was going for, when it says on account, it has to be accounts receivable or accounts payable. She answered the accounts payable because that's right, because we owe the money. So accounts payable, step one. Okay, so step two is accounts payable increasing or decreasing? Increasing. And what kind of account is accounts payable? Liability. And to increase a liability, what do we do to it? Credit. And that's what we thought anyway. So our next slide would be, okay, we're going to debit office supplies, which is an asset, credit account payable for the $200. Good job. See, that wasn't bad. In real life, you could include all the details you possibly would. In your world, you're either going to choose from 6 drop-down lists, and that distinction won't be important. So the question was, do we have to use the word on account in the memo line? And in real life, you would really have documentation, so you would include it. In the homework, you won't have to choose between that. Either it'll be included in it or it won't. So I guess I'm over here to you now. Okay. So the next one's April 4th. We paid $14,300 cash for land to use as a building site. So what's one account that's involved there? Cash. Cash Increasing or decreasing? Decreasing, correct. And what kind of account is cash? An asset. So to decrease an asset, what do we do? Decrease an asset. Credit. Okay. Now, as you're writing this down, make sure you skip a line. Credits always come last. So it's okay to identify the credit first, but it can't go on the first line. So we're crediting cash, we're indenting it, so we're going to credit cash. Now, let's go back to this. Now, now we're repeating, so we're back up to step one. What's the other account involved here? What are we buying? Land. Okay, so we have land. Okay, is land increasing or decreasing? Increasing, okay. And what kind of account is land? Look over there. Don't roll it. So what kind of account is land? Land would be like equipment and asset. Okay, so we're increasing an asset. So what do we do to increase an asset? Debit it. So there's our debit. Debit land for the purchase price. So we can go next, Brian. Okay, so we're going to debit land for $14,300, credit cash for $14,300. See, that works out. That was not too bad, was it? Okay, we're going to pause for 1 minute. I'm going to switch to, we're going to try something else so that people online can get this. I'm intentionally pausing for a minute. You're not going to hear me for a minute. Okay, you should be able to see this online. There's going to be a little bit of a lag, but we changed the way we're delivering it. So Brian, I'm going to not worry about that now. It's yours. I'm doing, And you can't do, we will not, while I'm doing it this way, you will not be clicking in questions because we can't get to polling the way we're doing it right now. But hopefully it'll be online. So I'm going to let you, Brian, deal with that. I'm going to just push myself through these. Okay. Okay, so next one, what? Okay, so next one, we just did April 4th. We paid cash for land to use as a building site. Okay, let me. You guys thought you were safe over here, didn't you? I'm coming to you. Okay, so let's do April 6th. Okay. So April 6th, we performed service for customers and received cash of $2,600. Okay. So our first question is, we performed service for customers and received cash. What's one account that's impacted there? What's one account? We performed service and received cash. Just what's one account? You're getting way ahead of me. Let's back up. Yes, you're on the right track, but we're going to back up for everyone's purposes. So we have cash, right? That's where you're going with it. So we have cash. So cash, is it increasing or decreasing? Increasing. And what type of account is cash? Asset. And then to increase an asset, that's where you said debit. So you were already on step 4 when I asked you. Okay. So we're going to debit cash for April 6th. For the $2,600. Okay. Now, what's the other account then that's involved? Because we know we need a credit. Service revenue is what you were thinking? Yes. Okay. Service revenue. When we perform service on account, when we perform services, we're earning revenue. Okay. So we would have a credit to service revenue. I think I'm out of range. Let me go back up here. Oops, I wasn't giving enough time. There we go. Okay. Okay, so what we're going to see there is we're going to debit cash for $2,600, credit service revenue for $2,600. Next one, we paid $100 on accounts payable. Stop in here. You're in range. Okay. So what's one account involved on April 9th? We paid $100 on accounts payable. We're down to the one that's below there. The one below the one circled. Yeah. Accounts payable. We're going with that. Okay. So is accounts payable increasing or decreasing? Decreasing, yes. And what kind of account is accounts payable?
No, accounts payable.
Liability. You said you have the L. Liability. Yes, liability.
Mm-hmm.
Okay. So then to decrease a liability, what do we do? Here. This is where, so we want to decrease a liability. Debit. So we're going to debit accounts payable for the $100, right?
Okay.
So that's one side. So then let's repeat. What's the other account involved here? What else is going on here? What are we paying?
Cash.
Cash. Exactly. So what kind of account is cash increasing or decreasing? Decreasing. And what kind of account is cash? An asset. And to decrease an asset, what do we do?
We credit it.
Credit it. Yes. So our entry is going, wait, did I go too far? I did. Okay. We're going to debit accounts payable and credit cash. Okay. Yeah, next. Okay, so that's April 9th. We're going to debit accounts payable, credit cash. Okay, so April 17th, we performed service on account totaling $1,900. Okay, so this is a little challenging, but can you give me one account that's involved in that, April 17th? On account, so it would be accounts payable or accounts receivable, which one? We're performing the service. Accounts receivable, yes, accounts receivable. So it's accounts receivable. Is accounts receivable increasing or decreasing? Increasing. And what type of account is accounts receivable? Asset? Asset. You're good. Yeah, okay, asset, okay? So debit, yeah, and we increase an asset by debiting it. So we're going to debit accounts receivable for $1,900. Now, for the other side, then, what's the other account that's involved here? Why would we perform service? What are we hoping to do? Earn revenue, right? Okay. So service revenue is the other account. Okay. So now, is service revenue increasing or decreasing? Increasing, correct. What kind of account is revenue, service revenue? It's revenue. But to increase a revenue, what do you do? Credit it, yes. So what we're going to see is we're going to see debiting accounts receivable and crediting service revenue. Hey, Brian. Brian, can you turn off the notification on my computer? Or who's got, not on my, on that one, the display one. No, it's that one. The plotting. Okay. Well, maybe, let's not mess with it. That's fine. Okay, next one. Okay. This one isn't bad. He had a harder one. Okay. It says April 23rd, collected $100 from the company on account. What's one account that's involved there? Cash, yes. So cash, is it increasing or decreasing? Increasing. And what kind of account is cash? Asset. And to increase an asset, what do we do? Debit. So we're going to have a debit for $100. Then what's the other account that's involved here? Accounts receivable, excellent, because this client is paying on the account. So accounts receivable is the other account that's involved here, and we would credit it. There we go. Okay. We credit accounts receivable, debit, cash. You can't do anything with me when I'm in an app share. Okay, so the last one I'm going to put it up here and I'm going to talk through it. Oops, I didn't mean to go that far. Okay, paid the following expenses. We paid salary for $1,900 and rent for $1,300. So what we're going to have, this is known as a compound entry. There are two expenses involved. So we have salary expense for $1,900. We have rent expense for $1,300. And our credit is going to be to cash for the total of the $1,900 and $1,300. So once again, our debits have to equal our credits. We're just saying that we paid this out of the check register, so you can have a compound entry. This compound entry just means there's more than one debit and or credit. But notice that our debits still have to equal our credit. Now we move on. So we have these journal entries. So journal entries, we record our transactions. But at some point, the journal entries need to impact the account. At the end of the period, I want to know how much cash I have. So I have 6 entries that affect cash. Well, I have to post them to the TAccount. So at the end of the period, the journal entries are posted to the account. We represent them in TAccounts because visually it works. We take debits. We put them on the left side of the TAccount. We have a TAccount for cash. We have a TAccount for common stock. We have a TAccount for salaries expense. So every account that would be in a journal entry would have a TAccount. So then we put the debits on the left side of those accounts, the credits on the right side. And at the end, we're going to have totals for those TAccounts like we did on Monday. So that was just that was in one of the video lectures. So, couple questions now before we do another homework problem. Company A received cash and issued stock to a new stockholder. In recording this transaction, so before I even look at the answer, this is what I'm doing. Remember, we can't poll anymore because of the way we're delivering this, so there won't be any answering in the window. So you can answer in the chat room. Brian hates when I say that because in the chat room just explodes with lines. So you don't really have to answer in the chat window. Okay, company A received cash and issued stock to a new stockholder in recording this transaction. So I'm going to do the journal entry. I'm going to ignore all those answers because quite frankly those answers can be confusing to me. So I'm going to say, okay, I received cash. Cash, I'm going to go with that. I received cash. Cash is an asset. To increase cash, I debit cash, okay? The other side, I issued stock. That's common stock. Common stock is an equity account. I'm increasing it, so I would credit common stock. So I have a debit to cash, an asset, and I have a credit to stockholder common stock. So looking at this, I see that my answer then has to be, I don't have to go very far, because I know my entry was to debit cash and credit common stock. So on these kind of accounts, it is the best strategy for you is to figure out the journal entry, then look at the answers, okay? Because the answers can be confusing. There can be a better answer than maybe the first one. Oops. I guess I went too far here. Okay, a journal entry that debits cash and credits accounts receivable indicates that. Okay, so if you think about it, what's going on here? We debit cash. That means we're increasing cash. So again, notice that I'm not looking at the answers. I'm looking at what's happening. A journal entry that debits cash, so we're increasing cash, and we're crediting accounts receivable. We're crediting accounts receivable being paid down. Somebody's making a payment. A customer's making a payment. So what's happening there is we're getting money on account. So that answer is going to be, okay, payment was received on account. Okay, 2.9, I'm not going to go over it right now. Oh, okay, well I will. 2.9, the solution is here. 2.9 is a list of accounts. I just want to show a trial balance. The trial balance lists every account. They are in order by assets first, then liabilities, then equities, and revenues, then expenses. Do they go in order? The debit balances go in the debit column, the credit balances go in the credit column, and when it's all said and done, your debit will equal credit. And again, I'm not going to go over this one now. I just wanted to use that as a point for a question that's coming up. And those 2.9 and 2.10 sometimes it's easy. I'll post how-tos on those slides, so I'll go through them. There is the answer. Accounts are listed in random order of trial balance, true or false. There's no suspense there, right? The answer. Okay, accounts are not listed in random first count in every balance sheet, and every trial balance is cash. Or two. Okay, we'll go with it. A trial balance is one of a company's major. That one is false. Okay, there are four financial statements, four major financial statements. There's the income statement, statement of retained earnings, balance sheet. Yeah. Okay. Okay. Yeah. A trial balance is one of the company's major financial statements. That is going to be false. There are four financial statements. We have a balance sheet. We have income statement, statement of retained earnings, and the statement of cash flows. Well, yeah, in case you're wondering online, I just put down my tablet and completely forgot that I was talking into the microphone. So that's what happens. That's not a technology glitch. That's my error. Okay, but fortunately, you could see what I was doing. We still have 2 minutes left. Okay, a trial balance is used to determine if. So the purpose of a trial balance is, the sole purpose of a trial balance is to make sure our total debits equal our total credits. We're making sure that total debits equal the total credits. That is the purpose of a trial balance.
Yeah.
Okay. So we're going with answers here. I have 2 questions left. Okay, so generally companies will prepare financial statements at the end of the accounting period. So we'll go right with the answers here. Companies are preparing financial statements at the end of the financial period, accounting period. So the end of the quarter, the end of the month, the end of the year. And then finally, oh great, we end with the computational one. Yay. Oops, wait, I skipped the answer there. It's in there. Okay. There we go. Okay. So company had credit sales of $30,000 and cash sales, so that gives them total revenue of $40,000. During May, they paid wages of $1,000 and paid $800 out. And then it also received payments from customers on account totaling $4,000. You do not, and when they're looking for the company's net income, you'll add your revenues, subtract your expenses, but payments from customers on accounts impact accounts receivable, not net income. So the income is $38,200. And as we end up here, I'll just end up on our last slide, which is just what's due this week, Chapter 2 homework, class quiz number 6, and video quiz number 7. Note that Chapter 4 is next. So when you're watching the video quizzes on Sunday, we are skipping 3 temporarily. We're going to do 3 on next Wednesday, but we're doing 4 first. So that's it. Have a nice weekend.